So today we have a very special guest with us, Mike Arone. Mike is a managing director and chief investment strategist for State Street Global Advisors, U.S. intermediary business group. He is responsible for expanding State Street Global Advisors' footprint and thought leadership efforts through frequent contributions to the financial news media, speaking engagements, and client interactions. He is a highly regarded speaker at industry conferences and is the author of several articles related to investment management practices. Mike is also a member of SSGA's senior leadership team. During his 20-year career as an investment professional, Mike has served as the global and EMEA head of portfolio strategy, as well as senior portfolio manager in the global active quantitative equity group. He has substantial experience developing long-only and long-short quantitative strategies and managing investment portfolios using quantitative disciplines. Mike holds a BS in finance from Bentley College. He has earned the Chartered Financial Analyst designation and is a member of the Boston Security Analyst Society and the CFA Institute. Welcome to the show, Mike.
Thanks, Austin. Really happy to be here. Appreciate it.
Welcome. Yeah. So let's dive right into what a quantitative long short. No, I'm just kidding.
No, but so you've had an impressive career that you've built, an impressive public presence. You frequent CNBC. I've seen you on Bloomberg TV. You'll also speak at conferences like for the CFA Institute and countless others. Does someone with your reputation ever get imposter syndrome? Like the kind of, who am I to be doing this feeling, or does that go away over time?
No, absolutely. You still get it. I feel like I play a portfolio manager on TV. So it certainly is one of these things where you're speaking and you're saying, boy, these folks listening are taking investment advice from me if they only knew. But I mean, kind of all jokes aside, there is an element of that. So there's a couple of things. I think for me, when I broke into the business at State Street Global Advisors back in 1997, the CEO used to say, if you didn't have butterflies in your stomach in advance of a meeting, an appearance, that type of thing, he knew something was amiss. So despite having done this a while, it's important to get that kind of nervous energy, that adrenaline flowing. And if you don't, there's kind of something a little bit kind of off on that. The other thing is look, markets are complex, they're dynamic. And if you don't know who you are, it's a very expensive place to find out. So through the course of our conversation, you'll kind of come to know that I approach this with a great deal of humility. Anyone who says their crystal ball is perfectly clear, run out the door and the other way, because that's a red flag for me.
I always tell clients, if I had that crystal ball, you wouldn't be talking to me, right? I'd be sitting on a beach sipping a pina colada somewhere.
Exactly. So I'm happy. I've been in the investment management industry for 30 years. I've done a lot of different things, and I'm happy to provide my kind of opinion with great conviction. But as always, we got to take these things with a grain of salt. I just did something, and there was a guy who was a CEO of Baxter out in Illinois, and he was saying he's changed it from Q&A to Q&O. So from questions and answers to questions and opinions, and that resonated with me, and that's what I think we'll do here today.
I like that a lot.
Yeah, that's great. That's great. So obviously you get very nervous appearing here on the show with Adam and I, but would you say you get more nervous talking to a TV anchor, right, where you don't know who this is going to go out to, or a room full of portfolio managers where there's someone sitting in the seat, thinking that, I'm smarter than this guy up here speaking to me?
I think the two ones that I get most nervous on are in front of your peers. I think it's really easier to present in front of strangers. People you don't know all that well. You get in front of a group of folks who are your peers, who know you pretty well, friends and family type of thing. I get a little bit more nervous on those ones. And then Austin, the second point on that, I always a little bit hesitant to do the CFA ones because I always felt like there's someone in the room. Like if I'm talking about, hey, here's something going on in the credit market, I'm waiting for the person who's like, well, I've managed, high yield investment portfolios for 30 years. And that's foolish. So I always recognize that there's likely someone in the room who's smarter and knows more about something than I do. And that always makes me a little nervous. So those are the two groups I get the butterflies with the most.
Right. And I think that's the beauty of the markets too, is there's always going to be varying opinions, and that's what sets the price, right? There's always going to be these competing thoughts. And that's how the market gets to where the market's priced at.
Right. There isn't one correct answer. It's a culmination of everyone's thoughts and opinions. And that's where it's weighing the possibilities with those probabilities that get assigned by everyone.
Absolutely. One of my kind of, more personal achievements or things that I was kind of proud of or surprised about, each January for the last 10 years, I forecast 3 surprises for markets. And I do it reluctantly. But I say, hey, look, as the chief investment strategist, that's kind of part of the job. And I remember a number of years ago when I first started, they had me present it to the portfolio managers on our investment team. And so I was talking about both high yield and currency. And the high yield investment professional and the currency professional both had a different opinion, an opposing opinion for me. And the forecast is for a year. And at the end of the year, I was right. Now, trust me, for career safety, I didn't go back and rub their noses in it. But I quietly and privately took note that, boy, here are these informed investors who were excellent at their jobs. We had differences of opinions to start the year. And at least over this 12-month period, I was right and they were wrong. And I quietly kind of celebrated, if you will, that had happened.
Right. So let's jump in. We're going to be talking a little bit about foreign markets and what perspective our investors and listeners should have, because I don't know if you had this on your bingo card, but foreign stock markets outperforming the U.S. by not just single digits, right? By a wide margin. So we're going to dive into, whether that we can look for that to continue, some of the trends that are driving that. I think a great place to start, though, would just be hearing a little bit about what your outlook is for the economy and the markets here in the U.S. And then we can dive into what the foreign markets have been doing and take a look at some of the contrasting information we might be looking at in the future.
Adam, I think it's perfect timing because when we're recording this, we're right about the midpoint of the year. And those second half outlooks are coming out. And of course, we just published our own. So it's kind of fresh in memory here from that perspective. I think from my viewpoint, I'm uncomfortably bullish for the remainder of the year. And why I say that is the following. When I look across some of the dynamics that have led to volatility in the first half, I think we're seeing some improvement there. So certainly it seems like the Trump administration and the U.S.'s global trading partners recognize that post-Liberation Day tariffs weren't sustainable. And there's at least a commitment to work on improving trade negotiations going forward. That's an important thing. The second thing is I think that the Trump administration is pivoting to some more of the pro-growth, traditional Republican tenets of their policy objectives. So deregulation, lower energy prices, and cutting taxes. And I think they're going to have some success there. So I think that's headed in the right direction. The second thing is I think, and we might get into this a little bit more, I think the Fed will have some wiggle room to cut rates in the second half of the year, and I think they'll do that. And that could stimulate the economy and risk assets in particular. A third thing is that I think earnings have come down. Certainly, the economy seems to be slowing, and there's uncertainty about policy. Current monetary policy is a little tight, and analysts have adjusted their earnings forecast to reduce them from about 15% for this year to about 9%. But that 9%, Adam, is still really solid. While they've done that, valuations are in a much better place now. They're kind of more in line with their recent 5-year averages. And finally, I think most folks, including myself, are not expecting a recession. I think the U.S. will avoid recession. So when I look at this, fiscal policy will get better, monetary policy will get better, earnings are still good, valuations are in a better place, and I think we'll avoid recession. I think that's an attractive backdrop for the balance of this year. There are certainly a number of risks, and we could talk about those, that still will kind of cause the market to be in suspense. It's the kind of unbearable burden of waiting and seeing. So there's a number of things that could go wrong, but I think that backdrop is pretty attractive for the second half of the year.
Yeah, I think when you consider those three things trending in the right direction, there's always going to be risks to any economic situation. I guess my biggest question is, was the uncertainty, albeit just for a couple of months because it is improving, was the uncertainty enough to do enough damage that, businesses have stopped production or lowered forecasts and earnings, removed targets and removed guidance. Is the damage done, I guess, would be my major question in your view, or is this repairable to this point? Ultimately, tariffs, and not to get into tariffs because everyone, your listeners and ours have probably heard enough about this, but ultimately it's a tax, right, on the consumer. So any tariff is probably not good compared to what it was prior. But is the damage done, I guess, would be my main question for you.
I'm not sure. I think that one of the big questions, this kind of unbearable burden of waiting and seeing, one of the big questions is, Adam, will this ominous soft data turn into recessionary hard data? And my opinion is that it won't. 3 years ago in 2022, you'll remember there was a lot of consternation, a lot of forecasts for recession that never materialized. I think we may be in a very similar boat. So I think one of the big questions in terms of waiting and seeing is investors are waiting and seeing if that damage is not repairable. And I don't think we're there. I think that the hard data, the hard economic data, the earnings data suggests that the economy is still doing okay. And as a result, I think we'll be able to kind of overcome some of the concerns and anxiety. I think there's also questions around, can we negotiate those trade agreements, especially with China? Will we be able to raise the debt ceiling and pass the One Big Beautiful Bill Act without increasing rates, inflation, and the deficit? And certainly, will the Fed be able to kind of thread the needle and get monetary policy just right without either reigniting inflation or causing a recession? Those are all the things we're waiting and seeing on. And I think it's caused some healthy volatility, but I'm confident that we're going to be okay in the second half of the year on some of these things. And as a result, I think markets will be able to respond to that.
So you mentioned the Fed. I think what's interesting is if you have Trump turning to the Fed saying, why aren't you lowering rates? You need to lower rates. How could you not lower rates? And then I feel like you have the Fed silently turning to Trump and saying, well, when we figure out what you're doing with these tariffs, maybe we could do that, right? So if you think the Fed is going to lower rates in the second half, do you think that we'll have a negotiated trade policy by the second half, or maybe Trump will back off, the tariff talks by the second half? Or do you think the Fed might be comfortable with where we are now?
I think the Trump administration already blinked on tariffs, and they are working towards trade deals with our trading partners. There's going to be a lot of headline risk, right? And even in the last little bit here, so we're in early June, we've had some kind of back and forth with Europe. We're going to increase tariffs. Oh, wait, let's give them some more time. Both the U.S. and China are accusing each other of not living up to the expectations of the May ceasefire on their kind of trade war, if we want to use that terminology. Yet, also in the background, there's kind of this murmuring that more trade deals are coming. So to me, I think that, I think Adam joked, hey, I'm kind of sick of this. I think the markets are comfortable with where we are on trade and tariffs, and they've moved on. And I think that's probably kind of about right from that standpoint. So to me, I think the risks for the Fed right now, where I have a bit of a bone to pick with the Fed, is two things. One, they expect that tariffs are inflationary. And I don't believe that's the case. It wasn't the case in 2018. And Adam mentioned it. You cannot say that tariffs are a tax and tell me they're inflationary. Those two things don't go together. They lower growth, they lower consumption if they're a tax. So I think the Fed's wrong on that front. The second thing is that 4.25 and 4.5 in terms of the target Fed funds rate, where they are today, they are notably above their preferred measure of inflation. So PCE, personal consumption expenditures, just came in. The all items number was 2.1%. And the one excluding food and energy, my joke here is who needs those things anyway, was 2.5%. And they're at 4.25, 4.5. So Adam and Austin, they could cut rates 25 basis points or 0.25%, 3 or 4 times and still be 1% above their preferred measure of inflation. I think the Fed risks being too tight for too long. And that's one of the risks to the market outlook as we move forward. So I kind of agree with Trump, and I know that'll make some folks angry. I think the Fed should be cutting rates.
Yeah, I'd probably lean with you on that, in that opinion. If you look at some of the non-top 10, 20% of the spenders in this country, it's not as pretty a picture as maybe the aggregate data would lead on. Should we move on to laying the land for what the international market's done here year to date, or do we want to?
No, let's go forward.
One thing, I guess, just to tie up in a bow the picture of the U.S. economy. You mentioned the valuations are more attractive today than they were. Valuations were pretty sky high, a couple standard deviations above the average going into this year, and that's clearly come in. But with earnings coming down and the market being pretty close to where the highs were, it seems like you think valuations are much more reasonable today. Can you just talk a little to that in 60 seconds or less?
Absolutely. So I think that, one, valuations are a poor predictor of short-term performance. And we're basically talking about, hey, what do we expect in the next 6 months? So I would agree that valuations are still elevated relative to history, but more in line with the last 5 years or so. So I'm not as concerned from that standpoint. And so I think that, again, valuations are not a great predictor. So when the only time they've really mattered was in 2022, when we had a big inflation spike. Other than that, central banks around the world have been manipulating the cost of capital through keeping rates artificially low, and valuations really haven't mattered. And so I think in some instances, we're kind of still working out of that regime. And so I'm not as concerned. So I wouldn't call stocks cheap. They're certainly above long-term averages, but valuations aren't a great predictor of short-term performance.
Great. Thank you. So let's dive into global market performance. I think that's been one of the big surprises. I don't know if you included that in your January newsletter, but at least for us, it's been a welcome change, right? To finally see diversifiers adding value to client portfolios. Maybe talk a little bit about how performance has been this year relative to the U.S. I know Germany's been an outstanding. Even emerging markets are picking up again. Let's talk a little bit about that lay of the land, and we can dive into what history might tell us about these trends shifting.
Sure. So as you mentioned, right now, as we're talking, the S&P's up about 1% so far this year with some high volatility. It was down close to 20% and then has come all the way back.
It's been a hell of a ride.
Hell of a ride, right? The roller coaster. So it's up about 1%. As you rightly point out, the MSCI EAFE index, which is developed markets outside the U.S., is up close to 17%. Germany's up more than 30%. Japan's up about 10%. Emerging markets are up about 9%. So markets outside the U.S. have done far better than those in the U.S. What's driving this? So one of the things we talked about, my experience and how long. And so one of the things that I've kind of learned as an investor is that you need to avoid linear kind of connections. A causes B. There's always a lot of things that ultimately result in what's happened. So a few things. We've been talking about valuations. So international developed and EM stocks were far cheaper than U.S. stocks to start the year. That's one. Two, you were kind of alluding to this notion that around kind of mean reversion. So U.S. stocks have dominated international and EM stocks over the last 15 years. So some of us who believe in this kind of statistical mean reversion would expect at some point that's got to change. That could be it. The other thing is that the U.S. economy and earnings were decelerating. They're still supposed to be higher than international markets, but the rate of change is slowing, where although many markets around the world have lower economic growth and lower earnings growth, the rate of change is increasing at a time when they're cheaper. So I think that shift is helping. Finally, we know the Trump administration is trying to reset both the national security framework. He wants our allies to share in the greater burden of global military security. And he's trying to reset the global trading system. So this has kind of led to a little bit more kind of impact. Mario Draghi, back in September, he was the former central banker for the ECB, the European Central Bank. He outlined a number of steps that Europe needed to take in order to increase their competitiveness. And at least it seems like they are. As we all know, Austin, Adam, and I, Germany passed a massive fiscal package earlier this year, which is highly unusual for that country, that could stimulate economic growth. So all of those things, I think, have conspired to result in international stocks performing better than U.S. stocks. And one of the big things is, as you both know, the U.S. dollar is down a little more than 8% for the year as we're talking. So a U.S.-based investor with international allocations in dollars, that's really been a big driver of that performance as well. And that's partly driven by the tough fiscal position of the U.S., as well as this kind of resetting of both the military framework globally and the global trading system. That has led to a weakness in dollars, and that has boosted international investments for U.S.-based investors.
Yeah. So I like what you said about the dollar and valuations. I'm a firm believer in mean reversion, but I feel like when you tell a client, to expect mean reversion, it's kind of like foo-foo magic juice, right? But when you talk about, we'll look at what these different countries are spending, right? And then look at what we're doing with Doge and things like that, trying to taper things back. In your article, you wrote about, there's an article you wrote about government spending where you write about this, shift from government spending versus private spending. We're seeing more government spending overseas, right? Trump, trying to push us more towards private spending here in the US. What's interesting to me is we've gone so long with U.S. government spending and this great U.S. stock market growth, and that points to, a client saying, all right, well, if they're stepping up spending overseas, I could see why that leads to growth, right? At the same token, I think you mentioned in the article that private spending is much more efficient than government spending. So could the U.S. actually, once we finish through this transition of moving, if we get there, to more private spending, could that be more efficiently to greater U.S. returns relative to the international spending and the growth there? Like, where's that balance?
Yeah, I think right now in the short term, investors are reacting to this notion that international stocks are inexpensive. There's some mean reversion. The rate of growth in terms of the economy and earnings are accelerating, not decelerating. That's in contrast to the U.S. And now all of a sudden you have some of this fiscal stimulus and monetary stimulus. Let's not forget that when Trump is beating up Powell, not literally, figuratively,
right,
that ultimately he's saying, look, the ECB's already cut rates 7 times and you've only cut 3. So they have both monetary policy and fiscal stimulus. So there's optimism that in places like Europe, these things will result in better earnings growth, better economic growth. Combine that with kind of undertaking some of the things that Mario Draghi outlined in his kind of report on competitiveness, lowering regulations, increasing innovation, increasing R&D spending, increasing defense spending, establishing energy independence, better trade agreements. These are all things that folks are excited about for Europe. So I think at least temporarily, that is driving this kind of shift in asset allocation, money, as well as in the performance. Now, Austin, I think you bring up a good point. So this century, profit margins in the U.S. have essentially doubled. They've almost doubled. And that is largely driven by 4 things, primarily falling interest rates, globalization, which has lowered costs, technology, because the profitability of technology companies from that standpoint, and lower corporate taxes. Those 4 things have resulted in a near doubling of profitability for U.S. companies. And this exists nowhere else in the world. So even today, companies in the S&P 500 have much better profit kind of margins, return on invested capital, return on equity, return on assets than anybody else. And that's why we perform better and why we deserve a premium from a valuation standpoint relative to everyone else. So the real question is, over the longer term, can those other countries catch up? And I'm still skeptical that they can. So I think this may be a welcomed and temporary shift, and one that's probably a little bit kind of overdue. But I think these other areas really have to demonstrate that they're going to really increase their profitability over the next 10 to 15 years relative to the U.S. And I think the jury's still out on that.
I mean, Silicon Valley took decades to turn it into what it is, an innovation hub here in the United States to farm, for lack of a better term, all of these technological innovations that, have helped increase these profit margins here that you've talked about. It makes me wonder, can that be replicated in Singapore or Munich or wherever? But if it takes 5 years to replicate it over there, what are the folks in Silicon Valley doing over those 5 years to continue to increase their lead, right?
Right. I just think it's a little too early to declare the end of U.S. exceptionalism over. Now, again, I'm not saying, Austin and Adam, that you're saying that, but there is certainly a greater chorus of folks questioning it. And I think questioning it is the right thing to do. And I think this shift is probably appropriate. So in the MSCI All Country World Index, a global benchmark, in December, the U.S. made up almost 70% of that benchmark. That was an all-time high. That's probably too high. And so some redistribution makes sense. But I'm not so sure that these other countries will be able to replicate kind of what happened in the U.S. over this last 25 years, where profitability almost doubled. I think that that's a heroic achievement. Remember, Germany has a surplus. They are in a very fiscally conservative position. That's not true of France. That's not true of Italy. So they're far more limited in terms of what they can do fiscally to kind of really drive growth. And I think that's what you're going to see play out here in the next few years. And so, again, I think that you'll see some reverberation or some kind of resetting of the U.S.'s kind of dominance is too strong a term, but leadership for sure.
Right. Yeah. In one hand, I look at the U.S. tech sector and I say, January 1995, it was the third smallest sector in the U.S. market. January 2000, it was the largest, representing about 28%. Or I look at like NVIDIA and I say, 5 years ago, NVIDIA was 0.35% of the world index. Now it's 4%. How quickly a company from overseas, right? If we just, say, well, what if this happened internationally, right? What if NVIDIA wasn't a U.S. company? How quickly things can change, right? In terms of the shape of the indice and things like that. On the other hand, I'm saying to myself, why has it taken, these international governments so long to, push forward with that spending, to, have more business friendly policies, right? If they see what's working in the US, how could they not say, hey, we want to grow too. We want to grow just as fast. We want to compete. Do you have an opinion on that?
So here's the thing that's, I think, really fascinating about this, Austin, right? So we think about what the Trump administration is trying to do to reset the global trading system, right? I think that certainly there's a notion that trade is kind of unbalanced and perhaps unfair, and they're trying to address that. But what I think is that's only one part of the equation. What they're not appreciating, or maybe what they're underestimating, is what we got in return for that, right? So you, Adam, and I know that ultimately we have an export. Our greatest export is U.S. dollars. And so because those U.S. dollars go to these other places, they have an excess savings. And Austin, what do they do with that savings? They invest it back in the U.S. market, in U.S. treasuries, in NVIDIA, in all these companies. And ultimately now, all of a sudden, to me, this is one of the things that hinges on some of the performance you've seen and begins to question about whether there is a real structural shift. So all of a sudden, if their appetite to take those dollars that they get from U.S. consumers and put them back into the U.S. market and U.S. treasuries, if that appetite isn't as strong and they decide to focus them more domestically at home or with their other trading partners, now all of a sudden international and emerging market assets become far more attractive and the dollar is likely to continue to be under pressure. That is a game changer. So the Trump administration wants to have its cake and eat it too. It wants to rebalance the military, kind of sharing the burden of military spending and global trade, but it still wants to have lower interest rates, benign inflation, a strong dollar. And I'm just thinking our trading partners are saying, not so fast. Nope. We're going to be a little less willing to fund your fiscal deficits. We're going to take this money and spend it at home and see if we can create our own Silicon Valley, our own tech leaders and that type of thing. That is a big shift and one that's worth watching.
Right. And I don't think the U.S. citizen really appreciates what that means for them. Right. With rates, with that ecosystem that you mentioned. Right. That's why mortgage rates are able to be as low as they are. Right. That's why borrowing rates can be as low as they are. If that disappears, then we're going to see those rates come up. And I don't think the average U.S. citizen really appreciates that.
Right. And I want to connect this right to what we've been chatting about as well. So one of the goals of the Trump administration, and they've been very vocal about it, is to lower 10-year Treasury yields. Treasury Secretary Besson has been very vocal that that's what they're focused on. They're not worried about stock market volatility. They want to bring those rates down. The reason they want to bring those rates down is because we have a massive deficit that needs to be funded. And we're going to have to lengthen maturities to do it at higher rates. And so they need to push those rates down to be able to do all the other things that they want to do. Yet you've signaled to the world, who you are kind of pissing off, I guess this is a podcast, we can use that technical term, right? And you're telling them this is your stated objective. And so the rest of the world might be putting a little pressure on you in order to say, hey, we're not as willing to buy at these levels. We need a little more from a yield perspective in order to kind of continue to fund these fiscal deficits. So it's interesting. This is why, bringing it back to what we said earlier, Trump is hammering Powell over the head to lower rates. He needs those rates lower. He wants those rates lower, but he doesn't control them as much as he might think. And ultimately, you're seeing some of the challenges that this is posing and some of the volatility that this is posing. Housing has been really challenged because of higher prices. There's not a lot of affordable housing supply, yet demand is pretty high, and yet mortgage rates remain very high. And this has been very problematic for the housing industry net large, construction, mortgage companies, housing companies, et cetera.
Right. Mike, you were talking about this ecosystem that's been set up that has caused the U.S. to be the dollar of trade. We're seeing maybe a little bit of a retraction from that right now, where the dollar is weakening. Maybe countries are less eager to be buying our U.S. Treasury, holding that U.S. dollar. It reminds me a little bit, I'm making a little bit of a stretch here, but the Plaza Accord situation, where back in the mid-'80s, the dollar was strong, the U.S. had a soaring trade deficit, and in an act of global economic coordination, the U.S. got together with Japan, Germany, France, and the U.K., and they said, let's fix this. And they struck a deal to intentionally bring down the dollar, which was called the Plaza Accord because the agreement was signed at the Plaza Hotel in New York City. And it worked. The dollar fell, trade imbalances narrowed, and markets adjusted. So obviously, we're not all sitting around a table, happily shaking these other countries' hands, saying, let's do this together. But do you think this could be a modern version of the Plaza Accord? Maybe not in form, but in function. Do you think the administration is purposely trying to weaken the dollar?
I absolutely do think that they're trying to weaken the dollar. So no president and no Treasury Secretary will ever come out on record and say they want a weak dollar. And they all talk a strong dollar, but they all quietly hope for a weaker dollar. So Stephen Miran, M-I-R-A-N, he's the chairman of the National Economic Council for President Trump and the Trump administration, Harvard economist. He has some kind of outlandish ideas, and they might be the right ideas. So again, as we talked about up front, I'm a humble guy. I'm not endorsing this. I'm not indicting it. I'm just kind of sharing with you what I think. So he wrote The User's Guide to Restructuring the Global Trading System. So for those who are kind of more curious and you're listening, Google it, check it out. One of the things that Stephen Miran believes, and he has the ear of the president, is that a stronger dollar has hurt the U.S.'s competitiveness. So ultimately, kind of like we've been chatting about, the U.S. believes that they have had the undue burden of providing the world's global security, and that a stronger dollar has hurt our competitiveness. So they want to share greater or more equally the burden of global security, and they want a weaker dollar because they think it'll help our competitiveness, increase our exports, help with lower rates, potentially attract more investment here. And so they are pursuing this, in my opinion, as a policy goal, although they'll never come out and say it. So again, if we think about this, if they're successful, it does make intuitive sense as a US dollar-based investor that some of these international allocations, which maybe I haven't owned in a while, where I'm massively underweight relative to what they stand in the global benchmark, I might want to start adding some of these in my investment portfolio to at least narrow the gap if I have one, or get back to some kind of level of semblance, because that will be kind of a positive shift for that. The last thing I'll say on this is that, just think of it this way, the US represents about 60% of the world's reserves, US dollar reserves. Yet we're only 26% of global GDP. So what we're talking about is restructuring this balance. And if we do, again, those international and EMs investments may be a bit more attractive, particularly at far lower valuations and after underperforming for the last 15 years.
Right. I like that. So it's diversification, not by sector necessarily, but also by currency, right? Where is your money being held? And that not many investors think of diversification that way.
Right. And Austin, it's a great segue, or and again, not that I'm trying to segue, but it's a great kind of pivot point to, there is no other kind of currency that's big enough, liquid enough, right? So I'm not here saying, in our lifetimes, the US dollar will continue to be the world's reserve currency. So we're talking about relative change. But what we are seeing is that the world is eager to diversify away from dollars. The Trump administration's kind of, pressing that kind of narrative. And so what's happened? Gold is at near a 5,000-year high. Bitcoin is at about 105,000 today as we're talking. So others are kind of, as they look to seek and diversify away from dollars, and the Trump administration is trying to lower kind of the dollar value, folks are searching elsewhere. Now, there's not a lot of good choices, right? There's not a lot of things that are big enough, liquid enough. But that's why you're seeing some of these things, yen doing better, euro doing better, gold doing better, Bitcoin doing better, because folks are diversifying away from US dollars.
Right. Don't you love how in environments like we're in today, gold price is soaring and all of a sudden the commercials start popping up for buy gold, your IRA is going to tank.
It could be another contrarian indicator, right?
Right. Yeah. Well, conventional wisdom would say that maybe gold is rising due to uncertainty, volatility, but to hear the dollar weakening argument and looking for a replacement of the dollar is quite interesting. That's not an argument I'd heard before, but it makes perfect sense.
Right? Nobody is replacing the dollar as the world's reserve currency anytime soon. But in 2009, China had 1.3 trillion in U.S. treasuries. Today, they have 761 billion. They have been buying gold and diversifying and reducing their treasury exposure. Now, again, so this has nothing to do with Trump, right? Like, he wasn't president that whole time. They have been purposely diversifying away from dollars because they had too many of them for years. And they're an adversary. They're competing for, global economic dominance. So that's happening. And I think in many ways, some of what the Trump administration wants to do will accelerate that. As a result, other non-dollar assets and alternatives are becoming more interesting.
Yeah.
Right. So do you think when Russia invaded Ukraine, that caused countries to take another look at their U.S. Treasury holdings? Because the U.S., did freeze Russian assets that were held in the U.S. dollar. Do you think that was a motivation at all, or do you think that wasn't really enough?
There's no coincidence that China's central bank started buying up gold in big chunks after that. They saw what happened to dollar assets held by Russia, and other countries took notice and said, we don't want to be that. We don't want that to happen to us. And they started it again. So I think that also has contributed to this trend, and this trend may continue. But again, we need to balance that, right? I'm always trying to bring this balance, because as an investor, what I want is, I don't want some gimmick on kind of diversifying away from dollars and, I'm a dollar-based investor and currency. I'm happy to take advantage of that. But what I really want to see is that the economies in Europe are growing faster. that their earnings are growing faster, that they're innovating, that they're deregulating, that they're energy independent. That's what you want to see as an investor, because that's more meaningful change. This will only kind of last, like we talked about. This transition will only last so long, or up to a certain point. And then you need earnings and economic growth and that type of thing to support those flows that have come to you.
So let's dive into that and peel back the layers of that onion a bit more. Let's assume some of this investment becomes more productive abroad, and we see less spending here from a government and fiscal perspective. Traditionally, you see decade-long spats of outperformance, whether it's U.S. or different foreign nations, right? It was Japan in the 80s. It was emerging markets in the mid-2000s. The 90s and the tech boom was obviously U.S. The last 15 years, we've talked about U.S. outperformance. Should we be thinking that we're at the dawn of another, call it 3, 5, 10-year period? I hate extrapolating out trends that far, and I'm not asking you to do that, but I'd be curious, bringing it back to the beginning, of your opinion on, whether this is something, just when you look at the valuation disparity between, let's say, Europe and the US, if their earnings are growing, if their valuations are cheaper, if our earnings are maybe declining, even though they're growing at a faster rate today, that narrative starts to look pretty nice for a long time looking out into the future.
Right. So I'm not fully there yet in terms of, so what I want to see is that earnings growth and economic growth, and that capital used more effectively, more efficiently, more productively. And so I'm not there yet. What's happened makes sense to me. You had a cheap asset that's underperformed for a long time. Now you're having a bit of a rate of change in both the economy and growth, and you're stimulating it through fiscal and monetary policy. At the same time, the U.S. is doing some things that would result in you saying, hey, let's kind of diversify away from dollar assets. Let's invest some of this at home. That all makes sense. And as we talked about, Germany's up more than 30% this year in U.S. dollar terms. EFA is up 17%. So that adjustment has been made. I want to see the follow through. But as it relates to portfolios, I have the great privilege of meeting with institutional clients and individual clients, where you all serve high net worth individuals and kind of what we think of as the mass affluent. And what I would say is that the trend has been lower and lower international assets and emerging market assets. Each year that they've lagged the US, folks have become less and less enthusiastic. So what I am saying is that I think it's time to at least start adding back, at least getting back towards benchmark weights in the global economy and buying some of those things, and not owning them or being massively underweight to international and EM assets. So I am saying investors should be doing that.
Yeah, we've been, it's been frustrating when the U.S. does outperform for decades and years and years and years, and you keep wondering why have that piece of the portfolio. It's been really refreshing to see, the fact that we've stood our ground in terms of diversification and seeing it play out and pan out. It's been nice to finally be able to look at that part of the portfolio and be reminded of why we have it. Right. And the contributions and the value it can add, especially when you see a 20% market correction here in the US, that's stressful. And to have the ballast, kind of anchoring the overall portfolios is really nice and welcomed in those types of times.
And to this point, right. So we're kind of talking, let's put a quick little kind of back of the envelope numbers here. So the MSCI All Country World Index is a very popular global benchmark. More recently, the U.S. is about 64% of that benchmark. So still a sizable sum. So your clients have a ton of their wealth. I will tell you that folks that I meet with, most folks that I meet with, investors that I meet with, have nowhere near 36% of their equity portfolio in the international. And that's what it represents in that benchmark. So all I'm saying is, hey, if you're at 10 or 15 or 0, you better start inching your way back up closer to that 36%. So I just wanted to provide that context there. The U.S. is still going to dominate and be the big chunk and the big driver of both your returns and volatility. But if you don't own any or you're massively underweight, that 36% in that particular kind of equity benchmark, it might be time to start increasing some of those allocations.
Now, let me ask you, do you think with the rise of globalization and the fact that if you look at U.S. domiciled companies, today they're getting far more, a greater percent of their revenues and earnings are coming from overseas sources. Does that impact the actual ultimate asset allocation you might arrive at the end of the day?
Potentially. So a lot of folks have pointed to the fact that S&P 500 companies, as you're suggesting, generate more than 40% of their revenues outside the United States.
Right.
And so they're saying, hey, look, I have international exposure, and there's some truth to that. But again, I would go back to this notion that the U.S. represents 60% of the world's reserves in terms of dollars exposure. 80 to 90% of the world's transactions, things that are bought and sold every day, are done in U.S. dollars. And I believe that that is likely to be a bit lower in the future, not higher. I think we've reached the peak levels. And as a result of that, I probably want some more exposure outside U.S. dollar assets. And I'd be looking to kind of add in those areas.
What about currency hedging? Right. I know that's popular these days. Is that something? Yeah. I feel like that's a zero-sum game, honestly. Right. So it's, you either bet one way or another. It's just adding a different thing to your portfolio that could potentially go wrong and hurt you.
Right.
At the end of the day.
What I've seen on this historically is I wouldn't try to time the currency hedging. That's when investors, institutions, and individuals always get it wrong, right? It's just like timing anything else. It's nearly impossible. So if you make the decision that you want to hedge some of your international exposure, hedge it, pick it out. And I'll tell you that kind of the consultant community in the institutional world, about 50% of non-U.S. exposure is hedged. So if that's what people want to do, great. What I'm saying is don't try to be hedged, unhedged, and try to time dollar moves.
Right.
If you get them wrong, you'll get whipsawed.
Yep, you're adding an extra variable there.
Don't hedge. Pick what level, and then kind of keep rebalancing to that level. I lived in London for a few years working for State Street Global Advisors. And for UK clients, you can imagine, right? So for us, given the world's reserve currency and all the things I mentioned, US investors hardly ever hedge, right? Like, why bother? But for UK, it's super important, right? And so I met with them and they said, boy, we're evaluating these two investments and we're super kind of confident. We've done all the work. We feel really confident on this one. I said, okay. And they said, this other one, we're skeptical. We've been burned before. And there was the currency hedging. And we're not so sure what to do. So what is your advice to us? I said, I would do the one you're not comfortable with. And I would do more work in questioning the thing that you're super confident, that you feel like it's airtight. What am I missing? And the jaws kind of hit the floor. And I think it took them by surprise. And they were like, why? I says, well, because you're probably overconfident on the one you feel so strongly about. And you've probably done a lot of work on the other, but the behavioral biases and being burned before has holding you back. And discomfort is often the best kind of way in which to earn money and make a profit is out of discomfort, not confidence. And they were like, oh, wow, that's interesting. So I'd say kind of the same thing around that currency hedging. Hedge, don't hedge, pick a number, do it, don't time it.
Yep.
Yeah,
I like that.
I like that a lot. A team that I work with internally, we're always reemphasizing the more comfortable you are with any sort of market knowledge or any type of investment, the more you have to question it. It's the ones that you're least comfortable with, that you don't have to question as much. You still need to do your due diligence on, but we really need to double down and triple down on, what we do believe in strongly, because that's where the behavioral biases really can be the strongest.
Right. Asking yourself, how could we be wrong? Yeah.
Right.
Yeah.
Right. So what about those investors who say my lifestyle is in the US, right? I'm buying US goods. I'm tied to the US inflation rate. Why do I need to invest internationally, right? Why do I need to hedge my currency risk? That's like having boat insurance, hedging against, my boat breaking down when I don't have a boat, right? Yeah. Do you have any thoughts on that?
I just think it's most investors that you are dealing with, they have a sizable portion of their assets in US dollars, right? But as you said, right, well, it's their buying power, their job, their investments, their house, their whole, if we were to look just beyond their portfolios, they have significant exposure to US dollars. So to me, it just gives this kind of diversification potential should, that begin to shift, should things begin to change. And as we talked about, if we're resetting the global security framework, we're resetting the global trading system, others are beginning to look more inward, and their appetite for US dollars is perhaps waning, then having some international exposure makes sense. You probably don't have as much as either you should or you think you have. And so I think adding some diversification does make some sense. Again, I go back to this notion that we only represent 25% of global GDP. Yet my guess is that most of your investors have 70 or 80% of their assets in dollars. That's a mismatch. And that mismatch should probably be adjusted, particularly given the current environment.
I've never seen a self-managed portfolio, right? We see statements all the time when we're bringing on new clients, but I've never seen, even existing clients or prospects, I've never seen a self-managed portfolio that has very many, if at all, foreign stocks in it. It's always home-based U.S. companies. And I think that proves your point there.
Absolutely. I think people today own very little international and emerging market assets. And I think the fact that they've underperformed for so long has only magnified that underweight or that not owning it. It's affirmed their conviction that they don't need it.
Well, this has been great. Do you have any final closing thoughts on this topic? And then, we can dive into any personal interests, hobbies, leave our listeners with maybe a little tidbit that they can take away that's non-investment related. But any closing remarks just on the international versus U.S. debate that we're seeing play out? Potentially shift here.
Yeah, I think kind of given what we've chatted about, one thing I have been talking to investors a bit more frequently about is that if in fact U.S. interest rates will be a bit higher and more volatile, doesn't mean we're going back to the early 80s, and inflation a bit stickier. If those two things are true, your stock portfolio will do just fine as long as the economy is expanding and earnings are growing, which is what I suggest we anticipate, at least for the next few quarters. And they are a good inflation hedge. That's been true this time. But your bond allocations may continue to be volatile and a bit more difficult. So from 82 to 2022, we had a 40-plus year bond bull market. Since then, it's been a bit of a slog. And so what I have been encouraging investors to do, and it kind of fits in the context of our conversation today, is maybe allocate a little bit more to a diversified portfolio of real assets. So that would include things like infrastructure, commodities, natural resources, gold. We've been chatting about gold, real estate, and the like. They generate some income, and should rates and inflation be a bit higher than anticipated, they'll do well. So for example, real assets have outperformed both stocks and bonds this year. In 2022, they did better than stocks and bonds. So at a time when there's a chance that rates could go up, hurting bond portfolios, and stock prices could go down, given some challenges, having a little bit more real assets, we've been encouraging folks to think about. And I would just I think it's adjacent to this idea.
Excellent. I like that. So what's new, Mike? What's any books you're reading, TV shows you're watching? On Sunday, I was very excited to tune into the last episode or what I thought was going to be the finale of The Last of Us. I don't know if you've seen that on HBO. Yeah. And I guess the episode before was the finale. I had no idea. It was just 7 episodes. I was very let down on Sunday night, but it concluded with a big cliffhanger. And I thought, wow, they're surely going to wrap this up.
I don't know if I get sucked in. Maybe it's a bit of a guilty pleasure. So I watched The Last of Us, and I mean that my wife and my daughter, they like to watch some of that. My wife and I just watched Peaky Blinders, a little bit of an older one.
I love Peaky Blinders. Yeah,
that's a great one.
And one that's kind of adjacent to that now is Mobland with Tom Hardy, who was in Peaky Blinders, and Pierce Brosnan. And it's kind of an modern day Irish gang family, but it's pretty violent, and so certainly some coarse language in there, but it's an entertaining show, lots of tension, lots of friction. So that's a little bit of what we've been streaming lately. In terms of books, I like to go back and look at a bit of older books. So I'm reading the Greatest Ever Bank Robbery. It's all about the savings and loan failures back in the late 1980s. And it's written by a guy, Martin Mayer, Mayer. So what's been interesting as I read it, one of the things that happens when you get kind of these global crises, right? So people like you and other investors will ask me, what keeps you up at night? What's the next black swan? Like, what are you thinking about? Those types of things.
Right. If it's something you're thinking about, it's probably not a black swan, right?
Exactly. But what's interesting is reading this, and I think one of the threads that you can always kind of see is that there's all this deregulation, and it can be on behalf of Democrats, Republicans, whatever. So they deregulated the savings and loan, the thrift industry pretty aggressively under the Reagan administration. And lots of bad actors started to come in as it started to increase. And it went bad, right? They started investing in all speculative stuff and crazy stuff, and they need to be bailed out. Think again what happened in the global financial crisis. Both under Clinton and Bush, they tried to deregulate housing to make housing more affordable and increase, which is a good policy goal. But that deregulation led to liar loans and all this other stuff, right? And so I'm just starting to think about, okay, well, what's been deregulated? We know that in the post-global financial crisis environment, a lot of traditional financial institutions were required to kind of take lending and particularly more speculative lending and get rid of it. So their tier one capital would go up, their safety would go up. But in a low rate environment, it went to other intermediaries, private credit, private equity. So I'm not saying that there's going to be a crisis, but I'm reading this book that was written in 1990, and it's helping me kind of make these loose connections about what to think about, right? And that's one of those connections that I made.
Right. That's very interesting. As an investor, you have to appreciate all the crosswinds. Not only do we keep repeating mistakes in different ways, but then all the different crosswinds that can occur in between that mistake and the final output that could make it so it either has an impact or it doesn't have an impact, right? It's very, very interesting.
Yeah, I think there's this notion, right, that we say or write, right, that history doesn't repeat itself, but often rhymes. So what are the ingredients to a good old-fashioned financial crisis? Well, oftentimes they start with significant government deregulation with a positive kind of policy goal, but then it gets a little too big, a little too speculative. Bad actors come in, and ultimately it needs to be readjusted. That seems to be some of the ingredients, at least. And again, maybe I'm kind of reading too much into this, but it made me think anyway.
Right. Get our tin hats on. Tinfoil hats.
Exactly.
Yeah, so great. So I'll just share. I've been watching. I try not to talk about shows, but we watch a lot of shows, and we happen to come across a good one. What kills me about it is you have to download MGM Plus, and who needs another app, right? Yeah. But the show is called Rogue Heroes, and it's the origins of the SAS, the British Army's Special Air Service, during World War II. And in the beginning of the show, it says based on a true story. And then underneath it, it reiterates. It says something like the events depicted which seem most unbelievable are mostly true. Because as you watch this, they're doing things and they're saying things and you're just like, I can't believe this is happening. This actually happened and it worked. And what I love about the show is it really captures that tension between structure and chaos, which I think is very much stock market-esque, right? Between the military hierarchy, that kind of radical thinking that, actually works sometimes. It's not just about the explosions and the tactics, but it's about, those unconventional ideas. Sometimes they come from the most unlikely people or unlikely spaces, right? And how that friction between the rebellious and the duty bound, ended up creating something legendary in this story. So I highly recommend it, even if you do the free trial for the app for 3 months or whatever it is.
All right, I wrote it down. I wrote it down.
Good. Well, if you like it, you'll have to shoot me a note. Let me know. Let me know. Great. So, Mike, it's been a pleasure having you here. We really appreciate you joining us. We hope you'll come back. A lot of great information shared. This has really been great.
Yeah, absolutely. Adam, awesome. Thank you for inviting me. I often joke that when you invite a guest on, you're taking a risk. You never know what they're going to say, especially if it's me. So I appreciate the trust. I had a blast, a lot of fun, and love to come back sometime. So thank you both.
Thank you. And to our listeners, please remember to like this video, or if you're listening through a podcast app, and please feel free to share. We love hearing your feedback as well. Until next time, thank you.